Right, when trading the wheel strategy, you know that there are 3 steps, and one of them is that you potentially could get assigned shares. And this is where you might be wondering, what if I don't want to get assigned? What are my possibilities there? And this is exactly what we're going to talk about today. And I will show you a very specific example because today, as I'm recording it, it is Friday, and this means that right now I have an put option that I will get assigned, and I will show you what other possibilities I have if I don't want to get assigned on this one. So let's get started. Okay, so you already know the wheel strategy, right? The wheel strategy is basically 3 steps. Number one, you are selling puts, and then you're potentially you're collecting premium. Step number two, you might get assigned if the stock dips below the strike price of the put that you sold. And again, we'll take a look at an example here right now. If you're not getting assigned, okay, no big deal. You go back to step number one. If you do get assigned, you go to step number three where you sell calls. But there might be a very specific situation where you say, you know what? I do not want to get assigned. So I want to show you 3 solutions here. And in order to do this, I want to show you a very specific trade that I did. And this is the trade on TPR. So this is a tapestry. As you can see, a few days ago, I sold the 37 put expiring April 8th. And this is today. So it is expiring today. And we have another 25 minutes that the markets are open. I sold it for $35 per contract. And so as you can see right now, as I'm zooming in here, the TPR right now is trading at 33.42. So this means that right now it is deep in the money. So I will get assigned, meaning that I have to buy shares for $37. Now, if it is trading right now at 33.42, it means that immediately I'm in the hole. And this is also a little bit too far away from the assigned price that I can probably not sell call options. So this is where we are going back to this. So what can I do right now? What are my 3 possibilities here? So number one, if I do not want to get assigned, I could just close the trade. And let's take a look at what exactly happened here. So as I'm going back to PowerX Optimizer and I'm going to the calculator, so I sold TPR for 40 cents, not 35. I was wrong here, so let's correct this. This was for 40 cents per contract, so this is $40 per contract. So let's say that now I want to get rid of the option. And we're going back here, and again, for this example, so we're using a very specific example, and this is where I sold TPR 37 puts expiring April 8th, which is today, for 40 cents per option. And if I'm looking here at the calculator, based on my account size, which is $250,000 in cash, which gives me a buying power of 500,000, I should trade 27 of these. Okay, so this means sold 27. We can do this 27 times these puts. Okay, so this gives you an idea. So scenario number one, I could just close out the trade. So let's see what this would look like if we are doing it. In order to do this, we are heading over here to my brokerage account, and we'll take a look here at TPR, and we are looking at the option. We are looking at the one that is expiring today, the 37, and now I could, it is a put, I could buy it back. So we buy it to close. And if I would do this for the whole, what did we say, the 27, you get an idea. Right now, the bid is $3.40 over $3.70. So the last traded price, as you can see here, is $3.60. So what would that mean? So if I'm buying it back, so close the trade by buying it back. Again, this would be under the scenario that I do not want to get assigned, right? What does it mean? Well, right now I can buy it back for $3.60, right? And I sold it for 40 cents. So this means that I would take a loss of $3.20. And this is $320 times 27 options. So let's calculate this. It is 320 times 27. So this would be a loss of $8,640. So $8,640 loss. That is one possibility, one scenario that we could do if we do not want to own this. Now, of course, this is not an ideal scenario because this is where we would be sitting on a rather large loss. So we don't want to do that. However, based on how you view this trade right now. So if you look at this and you're looking at the chart and you say, well, I'm looking here at TPR, I'm going back over the last 2 years and it has found solid support at 37. This is why I sold the 37. And now you say, maybe it is going down to 32, or maybe it is dropping all the way down to 14. So I don't want to take any more heat. I'm just closing out the trade. I'm taking my loss. Now, let's also, it sounds a little bit scary when we say, okay, an $640 loss. So again, if you're dividing this by the $250,000 that are in this account, and again, I'm using margin, so it's buying power, it's a little bit more, but if you divide it by the cash, so we're talking about a 3.5% loss. That should not be devastating for your account, but again, it is a loss nevertheless. Okay, so let's talk about another scenario, what you could do. You could roll the put option. So, and what does it mean when you roll the put option? Well, it basically means that you're buying back this week's put, and at the same time, you sell next week's put. And so at this point, we're just saying we're doing it at the 37 level. So we are just hoping, the idea here is you might say, okay, you know what, I hope that next week at some point, TPR will bounce back. I mean, overall, if you're looking at the broad market, so the S&P, we're coming down here again. So over the last few days, the S&P has been going down. The NASDAQ has been hit even harder. So TPR might come back, so you want to just avoid assignment for another week. So let's take a look at that scenario of what we would have to do there. And again, we're switching over here. Now we are not just closing it, we're using a multi-leg, and we say, okay, so we are buying to close this week's put, and at the same time, we are using the same strike price as we are going down here. And we are looking at a put option, and now we are selling to open 27 for next week. And you see what happens here. So here's the net quote. There's a debit of 10 cents and a credit of 30 cents. So somewhere in between, we would probably collect 10 cents for this. So we cannot collect any more premium here. So we would just avoid assignment for another week. And we'll talk about in a moment of why you might want to avoid assignment. So this is scenario one. Let's actually do this here. Let's call this scenario one. Okay, we close the trade and buying back. And here we have scenario two. Roll the put option, which we do here. So right now we'll take a look at this. So if we buy back this week's put and sell next one, oh, we already got this. We get a net credit that we receive of maybe 20 cents. So this is $20. And again, this would be times 27. So I mean, 27 contracts. So it's not bad at all. So this means that potentially we could make $540 by holding it for another week. So this is $540 additional premium. So since it is additional premium, let's mark this in green. There we go. Nobody can see that green. You get the idea. Okay, so this is another possibility. In this case, you would avoid assignment by another week. So let's talk about scenario three, and then I'll talk to you about what I'll do. Scenario three is basically do nothing and get assigned. So what are the differences? Why would you avoid assignment? So why avoiding assignment? Well, the biggest thing here is why you might want to avoid assignment. Actually, there's three reasons. Number one, you might say, I don't like the stock anymore, right? Because you looked at it, and when you sold the put, you really liked it, and now a few days later, maybe some circumstances have changed where you say, you know what, I don't really like it anymore, and I just want to get rid of it, and I'm fine getting rid of it at a loss. If this is the case, scenario 1 would be the best one. Number 2 is where you realize, I shouldn't have sold that many contracts. I don't have enough buying power to actually buy these shares, because when you're selling a put, your broker is just requiring a fraction of the buying power. And let's just take a look at this. So here, if we have 27 options at $37, the strike price, so let's see how much buying power you would tie up with this. So it's 27 times 37 times 100. So this would be 99,900. So $99,900 would be required in buying power. Now we'd say, don't have that much. I shouldn't have traded that many contracts in the first place. Well, in this case, you can actually think about either scenario 1 or scenario 2. Because this is where you can just push it out by another week, and then next week do the same thing, right? Next week, see if you want to just close the trade. And I mean, if TPR, of course, keeps tanking, you would sit at a larger loss. But if TPR bounces back, you would sit at a smaller loss. Or also next week, you could roll the put option. And even if here you would have a debit, here's what I'm going to do with this. So this is a highlight. Let's highlight this way, right? So if you would do it, you might have to give back some of the credit that you have received, but avoiding assignment, this might be something that you do. So, key question is, what do I do? What do I do? What is my plan? And according to my plan, I will take assignment. Because this is assignment, this is what my plan looks like, and this means I want the stock. Why? Because I've done the research, and before I entered the stock, and I think that here TPR is a solid value stock. I believe they're even paying a premium. We can just go there. If we go to not Finviz, if we go to finance.google.com, take a look at TPR and take a look at the underlyings here. Yeah, we see actually the PE ratio rather low. Let me zoom in a little bit. It's 11.27, the PE ratio. They're paying a dividend, and the dividend yield, as you can see, is 3%. That is not bad at all. As you can see, the quarterly revenue, pretty stable here. There are some seasonalities, not unusual for Tapestry, but annually, we see pretty good. 2020, as we all know, 2020 was a very special year, so no surprise that they were having a loss there, as many other companies had. But for 2021, looking solid, back basically to the levels where they were before the pandemic hit. So not bad at all. So this is where I am okay taking assignment. But I wanted to show you what options you have if you choose not to take any assignment. So you can either close it, often this would be at a loss, or you can roll it. Now, the important thing here is that you really pick value stocks, and I want to actually link to a video in the description that shows you exactly how I find the value stocks. I just briefly showed you how I use Google Finance, so I have a video that goes into more detail. Take a look at this, and then I'll see you in the next video.